Have you ever wondered how Warren Buffett became one of the richest people in the world? Believe it or not, he credits much of his success to one book, The Intelligent Investor by Benjamin Graham. But this book isn't just about picking stocks or chasing money, it's about building lasting wealth. It teaches you how to avoid the kinds of emotional decisions that lead most people to lose money, and how to think like a long-term investor, not a gambler. Even though it was written way back in 1949, its wisdom still hits home today. In a world full of social media hype, meme stocks, and get-rich-quick crypto schemes, Graham's message is simple: slow down, be rational, and invest with discipline. So, what's actually inside this legendary book? And why should you care? Stick around as we break down the key lessons and how they can transform the way you think about money. Part 1. Investing via speculating. First things first, Benjamin Graham draws a bold line between two very different players in the stock market: investors and speculators. An investor is someone who buys a stock because they've done their homework. They believe in the company's fundamentals, its long-term growth, steady earnings, strong management, and they're in it for the long haul. A speculator, on the other hand, is basically rolling the dice. They buy and sell based on short-term trends, media buzz, or gut feelings. It's not about the company, it's about the price and whether it's going up right now. Here's a simple way to picture it. An investor is like someone buying a house to live in for the next 10 years. They care about the foundation, the neighborhood, and whether it's a place they can grow. As speculator, they're flipping houses, buying fast, hoping to sell even faster, praying the market doesn't crash in the meantime. Graham's warning is clear. Many people think they're investing, but they're really just speculating in disguise. And that's where the danger lies. The key takeaway: speculation isn't evil, but you need to know which game you're playing, because the rules, the risks, and the mindset are completely different. And if you mix them up, that's when people lose big. Part 2. The concept of Mr. Market. One of Benjamin Graham's most famous and powerful ideas is the character he calls Mr. Market. Picture this. Every single day, Mr. Market knocks on your door with an offer. Sometimes, he's wildly optimistic. He'll buy your stocks at insanely high prices or sell you shares at a massive premium. Other days, he's gloomy and anxious, offering to sell stocks at rock-bottom prices because he thinks the world is falling apart. But here's the genius of it. You don't have to accept his offer. You can ignore him completely. Graham uses Mr. Market as a metaphor for how unpredictable and emotional the stock market can be. Some days, it's euphoric. Other days, it's panicking. But none of that means the actual value of a business has changed overnight. Let's say a company you've researched and truly believe in suddenly drops 20% in a week. Most people freak out. But Graham would say, take a breath. The business didn't suddenly become worthless. It might just be on sale. So what's the lesson here? Be rational. Use the market to your advantage, but never let it control your thinking. Don't let fear or greed steer the wheel. Stick to your long-term strategy. Trust your research. And remember, you can always say no to Mr. Market. Part 3. The margin of safety. Another powerful concept from Benjamin Graham is something he calls the margin of safety. And it's one of the most important ideas in all of investing. So what exactly is it? Think of it like a seatbelt. You don't get in your car expecting to crash, but if something goes wrong, that seatbelt could save your life. The margin of safety works the same way in the world of investing. It means you only buy a stock when it's priced well below what you believe it's actually worth. That way, if the company underperforms, or the economy slows down, or unexpected problems come up, you've got a cushion. Let's say you analyze a company and decide it's worth $100 per share based on its earnings, assets, and future potential. Graham would say, don't buy it at $100. Wait until it's selling for $80, or even $70. That gap, that margin, is your safety net. This isn't just theory. Warren Buffett, one of Graham's most famous students, calls the margin of safety the cornerstone of successful investing. Why? Because it forces you to be cautious. It builds in room for error. It keeps you from overpaying just because everyone else is hyped up. Bottom line, The margin of safety is about protecting yourself from the unknown. It's not about being scared, it's about being smart. Part 4. The Defensive vs. Enterprising Investor. Benjamin Graham also makes a crucial distinction between two types of intelligent investors, and knowing which one you are is the first step to investing wisely. First, there's the defensive investor. This person wants a safe, hands-off strategy. Maybe you don't have the time, energy, or interest to dig into financial statements, and that's totally fine. Graham says defensive investors should focus on low-cost, diversified options like index funds or high-grade bonds. For example, putting your money into an S&P 500 index fund gives you exposure to hundreds of top U.S. companies. It's low maintenance, historically reliable, and perfect for long-term growth without constant stress. Then there's the enterprising investor, someone who's willing to roll up their sleeves. This means actively researching companies, studying earnings reports, analyzing balance sheets, and looking for hidden value that others might miss. It takes time, effort, and discipline. But here's the catch, and it's a big one. Don't fool yourself. Just because you want higher returns doesn't mean you're ready for the work it takes to earn them. If you're not prepared to treat investing like a part-time job, you'll likely make costly mistakes. So, Graham's advice is simple but powerful. Be honest about who you are. If you're defensive, own it, and invest accordingly. There's no shame in playing it safe. In fact, that might be the smartest move you can make. Part 5. Emotions are your enemy. This might just be the most important idea in The Intelligent Investor, and honestly, it applies to everyone, just people in finance. Graham says, the investor's worst enemy is likely to be himself. Why? Because the biggest risks in investing aren't out there in the market, they're in our own minds. Fear and greed are powerful emotions, and they often lead us to make terrible decisions. When prices are rising, greed takes over. People get excited. They buy in at the top, thinking the good times will never end. Then, when the market dips, sometimes even just a little fear kicks in, and they panic sell at the worst possible time. The intelligent investor, on the other hand, doesn't get swept away by emotion. They stay calm. They focus on the long term, and most importantly, they stick to their strategy even when everyone else is freaking out. Let's take a real-world example. 2008. The global financial crisis. Stocks crashed. People saw their portfolios cut in half. And many panicked. They sold everything at a loss, just to feel safe. But those who understood Graham's wisdom, they didn't sell. Some even invested more while prices were low. And what happened? Over the next decade, markets not only recovered, they soared. Many of those disciplined investors saw their portfolios double or triple. So the lesson is clear. Master your emotions, or your emotions will master your money. So, what's the big takeaway from The Intelligent Investor? It's this: investing isn't about getting rich overnight. It's about building wealth slowly, wisely, and with discipline. Graham isn't offering shortcuts, he's giving you a blueprint for long-term success. Let's quickly recap the key principles. Don't speculate, invest. Know why you're buying something, and make sure it's based on research, not hype. Ignore Mr. Market. Just because prices move wildly doesn't mean you should. Stay focused on value, not noise. Always insist on a margin of safety. Buy investments when they're priced below their true worth. That cushion protects you when things don't go as planned. Know your strategy. Are you a defensive investor, looking for stability, or an enterprising one? Wait to dig deep and take calculated risks. And finally, control your emotions. Fear and greed ruin more portfolios than bad stocks ever could. Be steady. Be rational. Be patient. Whether you're just getting started or you've been in the market for years, Graham's advice still holds up. It's timeless. And the fact that Warren Buffett, one of the greatest investors ever, still recommends this book over 70 years later, that says everything. Read it, reread it, but most importantly, apply it. Thanks so much for watching. If you found this helpful, give it a like, hit subscribe for more book breakdowns, and let me know in the comments, what's your investing strategy?